This isn't a fear rally anymore, it's a structural repricing, and gold is marching toward $5,000 because the market is being forced to pay up for time, not just for metal. And the conflict is right here in plain sight. One side of the market wants you to believe this is a temporary headline. Spike, you can fade, while the other side is quietly behaving like supply is tighter, liquidity is thinner, and the next lurch higher could arrive when everyone's looking the other way. The hidden mechanism isn't a secret cabal, it's the plumbing. How futures, options, carry, and physical settlement pressures collide when positioning gets one-sided. Stay with me, because later I'm going to give you the 3 levels that matter right now, what would confirm a real $5,000 break in the next week or two, and the one thing that, if it flips, tells you the entire move is stalling before the crowd admits it. And that's where the real pressure starts. Look at what gold has done in recent trading. It didn't just drift up. It surged from the low to mid 4,000s into the doorstep of $5,000 with the kind of refuse to pull back behavior that usually shows up when a market is being absorbed. Absorption is the key word. In a normal hype move, price pops and then bleeds back because the bid was emotional, shallow, and temporary. In an absorbed move, every dip gets eaten and the tape starts to feel heavy in a strange way, heavy even while it rises, because anyone who tries to sell into it finds there's a buyer they can't scare. But that's not the part that matters. The part that matters is what this implies about who's buying, what they're buying for, and what the market is forced to do when the usual headwinds don't work. Because gold is not supposed to behave like this if the simplistic story is true. The simplistic story is the one you've heard 1,000 times. Rates might fall, inflation might return, geopolitical risk is up, so gold goes up. That story can be directionally helpful, sure, but it's also lazy. It turns a complex market into a mood ring. And when you trade gold like a mood ring, you get emotionally bullied by volatility. The real game is incentives and constraints, what's forcing participants to act. And right now, multiple parts of this market are being forced in the same direction. Not because they all agree on a headline, but because the math is tightening. Because if this one level breaks, the math changes. Start with the chart structure, because charts don't predict the future, but they do reveal behavior. What you want to see, if you're looking for a move that can keep going, is not a single vertical candle. You want to see a market that keeps printing new highs while pullbacks get smaller, shorter, and more embarrassing for sellers. You want to see failed breakdowns. You want to see what traders call weak hands getting shaken out on small dips while the bigger bid stays calm. And in gold, that's what the tape has been whispering. Dips are getting bought before they become stories. That is usually the signature of institutional demand that has a mandate, not a vibe. And here's the conflict. When a market behaves like that, it makes commentators uncomfortable because the safe take is always, it's extended, it'll mean revert. Mean reversion is a comforting bedtime story. Trend is a knife fight. And right now, gold is acting like a trend that refuses to apologize. But the real twist, the hidden detail that reframes the entire story, is this. Gold has been doing this while real yields are still capable of being meaningfully positive. In plain English, the opportunity cost argument should be louder. If you can earn solid inflation-adjusted returns in safe instruments, gold usually has to fight for attention. Yet gold is winning that fight anyway. That's not normal. That's your signal that something structural is overpowering the textbook headwind. And the next detail is what flips the whole setup. When gold rises in a world where real yields haven't collapsed, it usually points to one of 3 things. Currency stress beneath the surface, a reserve rashash sovereign and demand bid that doesn't care about carry, or a physical market dynamic where the marginal buyer wants the asset for reasons that aren't captured by a neat little rate model. You don't need to swear on conspiracies to accept that. You just need to follow incentives. Central banks, sovereigns, large pools of capital, when they decide they want diversification away from certain risks, they don't flinch at daily noise the way retail does. They rebalance. They accumulate. They treat drawdowns as a function of time, not trauma. That's why the moves can look unstoppable from the outside. But it's not unstoppable. It's just less sensitive to the kind of fear tactics that usually shake people out. And that's where the trap is set for most viewers. Because if you look at a $5,000 gold print and you think, I'm late, you're already in the wrong headspace. Your job is not to chase feelings. Your job is to understand mechanism, locate the stress points, and then decide what you do if price whips around violently, which it absolutely can, even if the thesis is correct. Because gold can be right and still hurt you. That line matters. Hold it. Now, let's talk about the part nobody on the surface wants to talk about. The carry and the curve. Gold is not corn. Gold is not oil. It doesn't get consumed in the same way. But it still trades in a structure that has a cost of carry, financing, storage, and time. Futures are not just a price forecast. They are a financing instrument with a calendar attached. If the futures curve is steep, It can mean carry is expensive, or demand for immediate settlement is soft, or financing conditions are tight. If the curve flattens or flips in odd ways, it can signal stress. People value now more than later. And when now gets expensive, arbitrage desks and hedgers are forced to do very specific things. That's the mechanism most people miss because it's not sexy, but it's the engine room. Here's the adult version in simple terms. If the spread between near term and later futures contracts changes, it changes the incentive to hold inventory, to deliver, to roll positions, and to hedge. If carrying metal becomes less attractive, supply can hesitate to come to market. If rolling futures becomes expensive for someone who's short, they feel the grind. If physical demand is persistent and the front end tightens, the market can start yelling through its spreads, even if the headline price looks fine. And spreads are where the truth leaks out first. But that's not the only leak. There's also the paper versus physical tension, and I'm not saying that like a cartoon villain story. I'm saying it like a settlement constraint. Futures can print a price instantly. Physical metal has to be sourced, transported, refined to spec, and delivered through a system with categories. What's deliverable for a contract, what sits in vaults but isn't actually available for delivery, what's earmarked, what's leased, what's spoken for. Those distinctions matter when the market gets stretched. Because a lot of the metal that exists is not for sale at the margin. It's jewelry, it's long-term holdings, it's reserves, it's buried in private hands, it's held by entities that don't care about price. So when real demand shows up, ETFs, central banks, institutions reallocating, the available float can shrink in a way that it's not obvious until the market starts reacting with that dip behavior. And then suddenly you see weird symptoms. Retail premiums in some corners, delays, shifting flows between locations, more attention on vault reports, more chatter about where the metal is. None of that needs to be perfect data to be meaningful. It's the direction and persistence that matter. Because the next detail is what flips the whole setup. If demand is persistent and the float is shrinking, the price doesn't need a dramatic catalyst to keep grinding. It just needs time. And time is exactly what the calendar is now offering. This is not a random week. We're sitting inside a period where liquidity can thin out fast, where month-end positioning matters, where funds are forced to rebalance, and where a single policy headline can trigger a violent move that has nothing to do with fundamentals in the moment. Think about what month-end and quarter-like behavior does. Systematic strategies rebalance based on volatility and performance. Risk parity and vol-targeted funds reduce or add exposure based on realized volatility. If gold's volatility compresses even while price rises, those strategies can be forced to add. If volatility spikes, they can be forced to cut, often at the worst time. That reflexivity is how markets weaponize volatility. And gold is especially good at it because it trades around a global clock with different liquidity pockets. One thin session, one surprise comment, one sudden surge in the dollar or yields, and you get a wick that makes people do something stupid. And that's exactly what the market will try to do to you if this is a real regime shift. It will try to make you quit. Now zoom out and ask, who's the buyer that doesn't care about your wick? That's where institutional flows come in. Gold ETFs are not the whole market, but they're a powerful thermometer. When ETF holdings climb persistently, it's telling you capital is choosing exposure that is meant to sit, not scalp. That matters because it removes supply from the tradable float, and it forces authorized participants and market makers to do hedging and sourcing work behind the scenes. If inflows are strong, someone needs to provide the metal exposure, and that can cascade into futures hedging and physical sourcing depending on how the pipes are set up. It's not always one-to-one, but it changes the rhythm of demand. And then you layer in central bank accumulation, arguably the most underappreciated and most structurally important demand driver of the last few years. Central banks don't buy because they saw a cute chart. They buy because they're managing reserve composition, sanction risk, geopolitical alignment, and long-term confidence. They buy because, for them, gold is not a trade. It's a policy tool. And policy tools don't get shaken out by a 2% drawdown. They get rebalanced over quarters and years. That's why the $5,000 conversation is not crazy, even if it sounds crazy. When a structurally insensitive bid is present, the upside tails get fatter, but don't get seduced by that sentence. Fat tails work both ways. If you ignore risk management, a fat tail can eat your account. So we're going to stay grounded. We're going to stack proof, not vibes. Proof point 1 is the tape behavior, repeated highs, shallow dips, quick recoveries. Proof point 2 is the macro headwind mismatch, strength despite real yields not collapsing. Proof point 3 is institutional flow. ETFs and central banks behaving like this is a reserve story, not a retail frenzy. Proof point 4 is the calendar, month-end, policy windows, and liquidity pockets setting up gap risk. Proof point 5 is market structure, the way $5,000 as a round number changes option dynamics and positioning. And proof point 6, because we are not relying on one argument, is the supply chain reality. Gold supply does not respond quickly, and a meaningful surge in demand can create multi-month tightness even without shortage headlines, and that's where the real pressure starts. Let's talk about supply, because people love to say gold is abundant. Yes, there's a lot of above-ground gold, but tradable supply at the margin is not the same thing as total existence. Mining is slow. Bringing new mines online is a multi-year process with permitting, financing, geology, and political risk. Recycling responds to price, but not instantly and not infinitely. People don't melt heirlooms every time price ticks up. Refining capacity and logistics matter because the market doesn't just need gold. It needs the right form in the right place at the right time. Bars, coins, kilobars, good delivery standards. These details become important when flows shift between regions. If demand pulls metal from one hub to another, the physical market can get tight in the places that set the tone for settlement and leasing. That is why watching vault holdings and flows can be useful even if the data isn't as a perfect mirror of the entire planet. It's a symptom check. If you see persistent drawdowns or unusual shifts, it tells you something about where the pressure is. And if you see increases, it can mean metal is returning to storage because stress is easing, or it can mean metal is being repositioned for delivery. Context matters. But you don't have to be perfect. You just have to watch the direction and the story it matches. Now, I want to address the thing your skeptical brain is screaming. Okay, but isn't this crowded? Isn't everyone already bullish? That's a healthy question. Crowding matters because crowded trades break violently when the narrative shifts. The way you test crowding is not by vibes, it's by participation and leverage. You look at futures positioning broadly. Are specs heavily long? You look at open interest behavior. Does open interest rise with price or fall? Rising open interest with rising price can signal new longs entering, but it can also signal shorts stepping in. Falling open interest with rising price can signal short covering. Both can support a move, but they imply different vulnerability. And you look at options, because options can quietly turn a grind into a sprint. Here's the mechanism explainer you need, in plain English. When a lot of call options get bought near a big round number like 5,000, dealers who sold those options may hedge by buying futures or spot as price rises. That buying can become forced and reflexive, especially if the market is in a positive gamma or negative gamma zone depending on positioning. The exact math can get complicated, but the takeaway is simple. Around key strikes and expiries, price can accelerate because hedgers are chasing it, not because someone woke up emotional. That's why the calendar matters again. Options expiry windows and month end can line up in nasty ways. It's not mystical, it's mechanical. And the next detail is what flips the whole setup. If gold approaches $5,000 into an expiry with heavy call open interest clustered near that number, you can get a magnet effect. If it breaks and holds, hedging flows can amplify. If it rejects hard, the unwind can amplify the drop. That's why you can't just shout $5,000 and call it a day. You need levels. You need a plan. You need an invalidation point. And you need a psychology shield because your emotions will be the easiest liquidity for the market to harvest. Here's that shield. First, separate trend from noise. Trend is the sequence of higher highs and higher lows over a meaningful time frame, supported by persistent buying on pullbacks. Noise is the intraday whip that happens around data, policy comments, and thin liquidity. Noise will try to convince you the trend is over every single week. It will do it with a sharp wick down that feels like the end of the world, followed by a recovery that makes you feel stupid. That emotional cycle is how the market extracts tolls. Second, understand that being right about direction is not the same as making money on a position. If you size too big, even a correct thesis can force you to puke at the low. Third, treat big round numbers like arenas, not finish lines. $5,000 is an arena. It's where orders cluster. It's where option strikes cluster. It's where commentary gets loud. That means volatility, not certainty. And that ice is where the trap is set. The crowd will buy the first exciting tick above $5,000 and panic sell the first scary wick below it. Professionals look for the opposite. They look for acceptance, retests, and structure. But that's not the part that matters. The part that matters is what the market is forcing participants to do if $5,000 becomes accepted value instead of rejected fantasy. Here, here's what changes. If we get a clean break and hold, underweight institutions start to feel career risk. That sounds dramatic, but it's real. If you manage money and you underweight the asset that S outperforming and it keeps outperforming, eventually you're forced to explain why you're missing it. That's how slow money becomes fast money. Then there's collateral and margin math. Gold is used as collateral in various forms, and rising price can change balance sheet constraints. Then there's the signaling effect. A clean break of a major psychological threshold can pull in momentum strategies, trend followers, and systematic allocations. Again, not because they believe, but because their models tell them to. And when models tell funds to buy, they don't ask permission, they execute. That can keep the bid under the market even when headlines go quiet. This is how you get those eerie periods where the chart is doing something big while the news feels oddly normal. But I'm not here to hypnotize you into blind bullishness. We need counterpoints, because skepticism is a risk tool. Counterpoint 1, real yields can rise further and a stronger dollar can still slap gold in the face, especially in the short term. Counterpoint 2, if positioning is too one-sided, a sudden risk-off move elsewhere can trigger margin calls that force liquidation across assets, including gold. Gold can get sold to meet cash needs, even if it's the safe haven. That's a brutal truth. Counterpoint 3, if physical tightness is overstated and supply reappears through leasing or shifting flows, spreads can relax and the market can cool without a dramatic crash. Counterpoint 4, policy surprise cuts both ways. If the Fed or other central banks signal tighter for longer more credibly than the market expects, you can get a sharp drawdown that tests conviction. Counterpoint 5, if risk assets melt up and volatility collapses, some fear premium narratives fade and gold can consolidate even while the long-term thesis remains intact. So what do we do with those counterpoints? We don't fear them. We build them into the plan. Because if you can name what would invalidate your thesis, you can survive being wrong without getting emotionally broken. And that's rare. Now let us connect the title, $5,000 Breakout Imminent in 2026, to the right now timeline, because this is where people either get value or get baited. The idea isn't that gold must hit $5,000 and never look back tomorrow. The idea is that the market is approaching a threshold where, if it's accepted, the path to higher levels later in 2026 becomes less about could it and more about what slows it. In other words, the breakout is a regime shift, not a one-day event. Regime shifts are messy. They come with sharp pullbacks, fake-outs, and violent squeezes. And they often come with denial from the old narrative. That denial is the conflict we started with. One side will keep saying, this is just geopolitics, or this is just rate cuts, because those are easy handles. The reality is more uncomfortable. Gold is acting like a reserve asset in a world where trust is being repriced, and market structure is amplifying moves around key levels. And the next detail is what flips the whole setup. Watch the spreads and the behavior around delivery windows and expiries. You don't need to memorize contract codes. You just need to observe whether the front end tightens, whether dips get bought faster as those dates approach, and whether moves happen in thin liquidity that feel like someone needed price higher. That needed is not a conspiracy word. It's a risk management word. Hedgers need to hedge, dealers need to hedge, funds need to rebalance. Institutions need to catch up. Needs create flows, flows create price creates more needs. That is reflexivity. And reflexivity is how you get the kind of move that makes $5,000 feel inevitable, right up until it whipsaws you if you don't respect it. Okay, let's get concrete. Here are the two scenarios you need in your head over the next week or two, and they both keep you honest. Scenario 1 is the controlled pullback and retest. Gold pushes into the $5,000 area, gets rejected or stalls, pulls back to a nearby support zone, and then holds. That retest is where a healthy trend proves itself. You want to see selling pressure fade on the pullback, and you want to see buyers step in without drama. If that happens, it builds a platform. Platforms are how markets go higher sustainably. In that scenario, the playbook is patience. You don't need to chase the first tick. You watch for acceptance and structure. Scenario 2 is the continuation squeeze. Gold breaks above the key level with force, liquidity thins, and price gaps are runs because hedgers and underweights are forced to chase. In that scenario, the risk isn't missing it. The risk is gap risk and emotional chasing. That scenario rewards people who already have a plan and punishes people who try to buy certainty after it was already printed. And the market loves punishing late certainty. So, which scenario is more likely? That's the wrong question. The right question is, what would confirm each and what would weaken each? Confirmation for the controlled pullback is simple. You see a pullback that doesn't accelerate, you see support hold, and you see price reclaim the key zone without needing a fresh headline. Confirmation for the squeeze is also simple. You see price break, hold above, and continue into closes, especially daily closes, that don't give the level back. Because in breakout arenas, closes matter more than intraday spikes. Now, what would weaken the bullish setup near term? A rejection that is violent, persistent, and accompanied by a change in behavior. Dips stop getting bought quickly. Rebounds become weaker, and the market starts making lower highs. Another invalidation signal is if the macro headwind that gold has been ignoring suddenly starts biting hard, like a sharp, sustained rise in real yields combined with a strengthening dollar that persists beyond a day or two. That's the kind of shift that can force funds to de-risk, not because the long-term reserve story disappears, but because near-term risk management takes over. And if that happens, you don't argue with it. You adapt. That's how you stay in the game. Now let's talk about what to watch next, because this is where trust is built, not with predictions, but with checkpoints. Checkpoint 1, the $5,000 zone itself. Does price get accepted above it or slapped down? Watch closes, not just wicks. Checkpoint 2, the first meaningful support beneath it. Call it the line in the sand, where if price falls and stays below, the breakout narrative is delayed. I'm not going to pretend I can give you a magical single dollar level that is perfect in all contexts, because markets don't respect our need for neatness. But you can define it on your chart. The prior breakout area, the last consolidation shelf, the level where dips have repeatedly been defended. That's your support. If price breaks that and can't reclaim it, you downgrade the thesis near term. Checkpoint 3, how the market behaves around the calendar. Policy decisions, month-end, options windows. Does volatility spike and then get absorbed? Or does volatility spike and then start a cascade lower? Absorption after a spike is bullish. Cascade after a spike is warning. Checkpoint 4, the hidden detail metric, real yields and the dollar. If gold continues to hold up, even as those remain firm, it tells you the structural bid is still present. If gold starts to correlate negatively again, falling sharply when real yields rise, that can mean the market is reverting to the old regime. That doesn't kill the 2026 story, but it changes the short-term path. And the next detail is what flips the whole setup. Watch for the moment narratives change after the tape has already moved. That's a classic sign of a regime shift. First the market moves, then the stories catch up, then the retail crowd arrives, then the market punishes them with volatility. Your job is to not be the liquidity for that punishment. Here's how volatility will try to manipulate you specifically. It will bait you with a clean breakout candle and headlines that sound definitive so you feel safe buying high. Then it will slam price down intraday to make you feel foolish and unsafe, so you sell low. Then it will recover and you'll feel regret. And regret is the emotion that makes you chase. That loop, safety, shame, regret, is the loop that drains accounts. The antidote is simple, but not easy. Decide your time horizon and size accordingly. If you're a short-term trader, you need clear invalidation and you accept frequent stops. If you're longer term, you accept noise and focus on structural signals. And if you can't tolerate a 5 to 10% whip in a volatile market without panicking, you're sized wrong, period. That's not a judgment, that's physics. Markets don't care about your feelings, but they absolutely will monetize them. Now, let's bring back the idea of $5,000 in 2026, because people hear that number and they either get greedy or dismissive. Both reactions are emotional. A more useful frame is this. If gold is already testing the upper $4,000 and flirting with $5,000 now, then the question for the rest of 2026 becomes, do we get consolidation that builds a base for a larger move, or do we get a blow-off that resets sentiment? Those are very different paths, and they demand different behavior. A base-building path often looks boring and frustrating, sideways, choppy, dead to impatient people, until it breaks again. A blow-off path looks exhilarating fast, vertical, euphoric, until it snaps back. If you understand that, you stop being shocked by normal market behavior. You stop treating every dip like betrayal, and you start trading like someone who respects structure. And that's where the real pressure starts. Now I want to talk about one more underappreciated driver, global comparison and arbitrage. Gold is priced globally, but demand is regional, and sometimes the price of urgency shows up in where premiums appear, where imports flow, and where metal moves. When one region bids aggressively because of currency weakness, policy uncertainty, or cultural demand, it can pull metal through trade flows, and that can tighten other hubs. Arbitrage keeps markets connected, but arbitrage isn't instant, and it isn't free. It relies on logistics, financing, and trust. When those are strained, price differentials can widen. And when differentials widen, the global market is telling you stress exists somewhere. Again, you don't have to pretend you can see every container. You just need to respect that gold is not only a US rates story, it's a global reserve and savings story. That's why the real yields are positive hidden detail matters so much. It tells you the buyer might be optimizing for something other than yield, like stability, sovereignty, and risk insulation. And when that buyer shows up in size, the market changes character. So here's the concrete payoff I promised, the near-term roadmap. Over the next 1 to 2 weeks, treat $5,000 as the arena. If we get a clean push above it, you watch for acceptance. Does price hold above on pullbacks, and do daily closes stay firm? If yes, you're likely in the squeeze scenario, and you respect gap risk, meaning you don't assume you'll get a polite entry. If we fail at $5,000 and pull back, you watch the first defended shelf below. Does it hold? And do buyers show up without needing a dramatic headline? If yes, that's constructive. Platform building. If that shelf breaks and price can't reclaim it quickly, you downgrade the breakout thesis near term and you wait for structure to rebuild. Meanwhile, keep one eye on the macro tripwires. A sustained surge in real yields and the dollar can force de-risking even in structurally bullish assets. And keep one eye on the calendar. Policy windows and month-end can turn a calm market into a whip in a single session. Your job is not to predict the wick. Your job is to survive it with a plan. And here's the subtle CTA, because this matters more than smash buttons. If you're the kind of investor who wants mechanisms, not slogans, who wants to know what forces participants to act, what level changes the math, what invalidates the thesis, then you're already part of the tiny minority that actually survives these regimes. Stay in that mindset. Track the checkpoints, respect the volatility weapon, and don't let a one-day move decide your identity. Because if $5,000 becomes accepted value, the bigger story in 2026 won't be that gold surged. It'll be that the world quietly repriced trust, and the market can't unsee it.